Good morning. In terms of business preparedness for insurance for your business, let's have a quick conversation about what you need to think about for your company. And first of all, let's start with some best practices. What are best practices for you as a business owner running a company? Well, some of the best practices out there are have an annual review of your insurance policies, all of them. Now, who wants another admin project? Nobody, right? Well, that makes sense, but think about your business a year ago and think about it today. In that 12 months, what has changed? Do you have new locations? Do you have new employees? Do you have new products or new services? What is different? And has your insurance policy kept up? That's what an annual review does. When you think about your company and all those insurance policies you have to keep your business safe and intact as much as you can, then you want to have the annual review to re-look at everything all over again because your business, no doubt, has changed. And an insurance audit. What is an insurance audit? An insurance audit means that somebody comes in, independent third party, takes a look at what you've already structured and what you have in place, and they look to see, is it what you really should have for your company? What gaps exist, if any? And if there are gaps, what is the best way for you to address those gaps? So an insurance audit is a good way to understand what you have, what you don't have, and what you should have in your business. And let me talk about insurance brokers for a moment here. If you work with what's called a captive insurance agent, that means one agent, he or she represents one company. Well, if they represent one company, they only represent that one company. The benefit of going to an insurance brokerage firm is they represent many companies, and they don't care necessarily which insurance company you end up with. What they care about is getting you, their customer, their client, getting you what makes the most sense for you. So they talk with you, they listen to you, they understand what is happening with your company and what your needs are, and then they go to the marketplace and they shop you with different insurance companies. That's what an independent brokerage firm will do. So that insurance audit that you should have every so often should be done by that independent brokerage who looks at many companies, not beholden to any one of them, but instead beholden to you, their client, their customer. Keyman Insurance. Many people don't understand that Keyman Insurance is there to help keep that company intact. And what it does is it is life insurance on one of your key people in your company. So why does that matter? Well, there are probably a handful of people in your business, one, two, three, or four or so. And if one of those people is suddenly gone, they suddenly pass away, it will impact the daily operations of your business. It will disrupt the business. So the Keyman life insurance policy is designed to then, if they suddenly die, gives you a chunk of money. Now you take that money and you have a recruiting firm go to work for you. They go out, they do a search to find the right person for you. Recruiting companies typically get paid about 30% of the annual salary. So if you're paying that person, your employee, say 200,000 a year, 30% is 60,000. That's the fee just to find the person, bring them in. And even if you get the best person out there with all the expertise and everything that you need, it will take him or her some time to ramp up and get into full efficiency and full productivity for you. There's just always a startup that has to happen whenever a new situation comes about. So the Keyman life insurance policy or Keyman policy on a key person in your company is critical to keep everything flowing as well as possible. If there's the unexpected passing of one of your key people. Let's talk about disability insurance. Disability insurance is something that is important if somebody cannot work for you for a time. They get sick, they get they're hospitalized for something. So a disability policy can be short-term or it can be long-term. Short-term is intended to replace the income, the family income for that person if they're not working. And it can be short-term, meaning within, say, the first 3 months, or maybe it's a longer term, maybe it's even permanent. But that's what policies are designed for, to help the family. But why does that matter to the business owner? Well, you always want to make sure you take care of your key people, obviously, in addition to take care of all the employees. But when you think about a disability policy, that's one area where you can have what's called a carve out. And a carve out means you look at all the employees and you are able to pull a few of those out and do something just for them. There's this word in employment called discrimination that nobody likes, but in this instance, a carve out is a way where you can legally separate people from the other employees for the benefit of the company. And it makes logical sense. Some of those people, if they're not there tomorrow, it impacts your business immediately. When others, well, they matter too, yes, but they're not going to stop operations for you. So you can have a carve out in your employee benefits, and that could be with a long-term care or a long-term disability policy where you can identify, say, 3 key people and give that just to them. It's perfectly legal. It makes perfectly rational, logical sense within a business setting because they keep that company going. They are critical to the ongoing nature of that business. Also, speaking of carve-outs, you can have what's called a non-qualified plan, and sometimes called non-qualified benefits. Well, what is that? Non-qualified means you do not get a tax deduction. It is not a business expense that you can flush through the company books. A non-qualified plan is intended to help you put something specific in place, again, for key people. And I've seen this put in place before in a variety of situations. One example that is pretty simple to understand is the CEO of a hospital. He or she can have a non-qualified plan just for that one person. Well, why would the employee want that? Because you can set up a carved out retirement package just for them with this non-qualified plan. So in your business, do you have people who are critical to the ongoing day-to-day operations? Well, if so, what can you do to make sure you keep them? You've got to retain good people. It's expensive to replace good qualified people, and it takes a lot of time. So you want to keep them on board. You can do it with non-qualified plans, with carve-outs and other types of benefits for them as well. But that's why you want to make sure you understand who those people are and how do you build um, um, a system around them that makes them want to stay. So it helps you to retain them. And that's what this carve out's going to help you do. Let's talk about business continuity. Business continuity insurance exists. So when COVID came along in 2020, it stopped literally everybody's company dead in its tracks. Had you had business continuity insurance, it could have covered that situation because that was a brand new situation. Well, what does that mean? Business continuity means that if there is some kind of a disruption in your business, money keeps coming in. So if your revenues, your sales suddenly stop, that business continuity insurance is designed to start replacing that revenue with another source of cash flow. But where's the cash coming from? It comes from that insurance policy. That's what the business continuity insurance policy is. It's just for that specific purpose. Business continuity insurance. Let's talk about a term that you might not have heard before called reinsurance. Reinsurance, what does that mean? It means that there's a secondary layer of insurance. The most famous reinsurance company out there today on the planet is Lloyd's of London. We've all probably heard of Lloyd's of London. What do? They reinsure. So earlier this year in 2025, we saw those devastating wildfires in Los Angeles. Right? And the people had homeowners insurance, many of them. Some did not, but many of them did. And the insurance policies were with companies like State Farm, Allstate, Geico, all the traditional home insurance carriers. Those fires were so devastating that many of those insurance companies had to go to their insurance company to get money from them to help pay for those burned down houses. That is called reinsurance. So the insurance companies can have their own secondary layer of insurance. That is reinsurance. Well, you can have that yourself as well. And I'll talk first about, let me finish with reinsurance. If your State Farm policy on your business, for example, is going to cover you for $2 million of liability, you can have a reinsurance policy on top of that. So if you have a claim or a lawsuit and there's a $3 million judgment, but your insurance policy only covers for $2 million, well, where does that other $1 million come from? It comes from the company's pockets. And if you have not built that solid wall between your business and your family then that $1 million will come from your family. So that's why it's super important. You've got a very thick wall built up, sometimes called the Chinese wall, between the business and the family. And the way you help build that wall to get that separation, you do it with trusts, with business entities, and insurance. And in this conversation, I'm focusing solely on insurance. So that reinsurance, that's what that's for. Let's talk about self-insuring. You can consciously self-insure risks in your business or unconsciously. So if you have an insurance policy that you did not renew, then that means you are now responsible for that potential liability. You knowingly did not renew that insurance policy. So now you know if something happens, you, the business, the company, you are on the hook. You've got to pay for that liability, and you are now taking that risk on full on. You are in self-insuring. That is knowingly self-insuring. Well, sometimes there are risks in a business that we don't know about, and they show up and they can be devastating. So that would be you self-insuring without knowing it. And that gets back to why that insurance review is so important. Have that insurance audit so that all of the risks in your business, they're identified, and you make a conscious decision to get an insurance policy to cover them, or you make a conscious decision to say, no, I'm willing to take that risk. But you want to know, you don't want to go in blind. The last point I'll make about being prepared within your business in the insurance context is I'll talk about captive insurance companies. Well, a captive insurance company is a way to self-insure risks in your business. Now, IRS has been all over captives for years, so you may or may not want to go there. It's not that the captive insurance companies are bad. That's not what it is at all. What it is a lot of people got into the captive insurance space. They did not follow the rules. IRS became aware of it and they went after them. So it's been under the spotlight for IRS. But let me talk about why you might want to consider a captive insurance company for your business. A captive insurance company is there for you to self-insure. It's a formal program that you set up to insure your business against risks that could come along. Well, what kinds of risk? Well, all kinds of risks. That's why you have insurance policies. So the captive insurance means you set up your own company that is an insurance company. You go to your operating business, and now you pay that insurance premium. Instead of paying that to, say, State Farm, you pay it to your other company. For your operating business, it is a deductible business expense. And when the money goes into your other company, that insurance premium, that is not income that is taxable. It is not revenue. Now, there are elections that have to get made to make all this work, but what I'm describing is the big picture, the 30,000-foot level of this captive. So you are self-insuring, you set up a legal entity, it's a new business expense, and that new business expense is a deductible business expense in your operating business. Today in 2025, the maximum deductible expense each year for a captive insurance premium is about $2.85 million. That's almost $3 million as a deductible business expense. Now, you don't do this for the taxes. That's not the purpose. This is what's called a risk mitigation strategy, a risk mitigation tool. The idea is to help address a potential risk in your business. So you have to hire an actuarial firm that comes into your company. They do an evaluation of your business. They look at all of those risks. They actuarially, statistically look at the likelihood of that risk. They assign a premium to it, an annual insurance premium to it, and they go through and create this actual study that comes out with real actuarial-based numbers. And then that determines what that premium, what that annual cost will be for that insurance policy that is part of your captive insurance company. So it's a pretty complex tool, but in the right situation, it can be the best tool out there. And when you think about a captive insurance company, think about this. Most of those very giant companies out there, they have their own captive insurance companies. This isn't anything that is deep and dark and secret. It is a real part of the Internal Revenue Service tax code, been around for a very, very long time. And the big name brand companies out there, they have captive insurance companies as a way of reducing their expenses to address risks in their business. And think about whatever the big companies can do, you can do in your small company as well, because they are making use of federal tax law, which applies to them just like it applies to you. Even if you get a little one-man shop, or you have 50 employees or 100 or 10,000 employees, it's the same federal law. And that's what you're looking at when you look at a captive insurance company to help minimize those risks or reduce those risks. And when you have a captive and you are self-insuring, you can also have a reinsurance policy on top of your captive, so that in case there is something that is just catastrophic, then Lloyd's of London can give you that secondary layer of protection that could be really crucial, really critical to you in your business. So I hope this is helpful. Again, best practices annual review. If you'd like to have an insurance review on your business, the best way is to reach out to me, have a conversation with me, and then we can talk about that, because we're happy to provide that to you. And it won't cost you much, if anything, at all. We don't offer that to everyone, but I'm saying that an insurance review is really, really important in your business, so that you know what those risks are and you address them, or you choose not to address them, but only when you know all of those risks and what they potentially might mean to your company, to your bottom line, and that it makes sense to you. Any questions? Reach out, give me a call. Happy to have a conversation with you.